And it's my pleasure to introduce the LDEI third Vice President, Liz Barrett. Liz, you need to unmute yourself.
Thank you. Hi, everybody, and thank you, Greg. We are very happy to be able to offer this webinar today where everybody's going to learn about this earned or employee retention credit so that business owners, you're not leaving money on the table. I'm going to introduce our speakers today, and I will say maybe on your Zoom you want to switch to the speaker view on the upper right hand, so your screen will be filled with the speaker at that point. We have first, thank you to Leslie Comet, our Dom in San Antonio, who connected us with the women at ATK, a certified public accounting firm in San Antonio, woman-owned, which is quite appropriate. And first, I want to introduce Allison Miller, who is a CPA, tax partner and director of federal law. She graduated summa cum laude from Texas A&M University with bachelor's and master's degrees in accounting. After 10 years at one of the big four firms, she joined ATKG, and she is currently the head of their federal tax practice. Her expertise includes wealth management, restaurants, real estate, farm and ranch, and professional services. And she is into building lasting relationships with her clients. And we are happy to have you here. Allison, why don't you wave your hand so you can stick out on the screen. There we go. And then we have Annette Goodson, who is also a CPA, tax director, state and local tax leader. She is currently head of the firm's state and local tax practice and has 25 plus years of public accounting experience. She enjoys using her analytical strengths and research skills to work on strategies for clients, and she got her bachelor's degree in accounting from the University of Texas in San Antonio. And if you want to give a wave, Annette.
Hello, everyone.
And then finally, I want to introduce Melanie Kirk, who is the managing partner of ATKG. She is a graduate of Trinity University with a Bachelor of Science degree with a concentration in accounting. She has broad CPA experience ranging from real estate, farm and ranch, oil and gas, retail, and professional services. She's very deeply entrenched in the National Association of Women Business Owners and a past board member of the San Antonio chapter. She is everywhere all the time, it looks like, from reading your bio. You're very involved in a number of organizations. And of course, we were happy to see the NABO affiliation. So Melanie is going to be the facilitator and moderator of the conversation. So I'm going to hand it over to her. And as Greg said, please do post questions in the chat bar, and we'll get to those either as we go or we'll leave a few minutes at the end. And I'm going to mute my own self now.
All right. Well, thanks, Liz. We're so happy to be here today. ATKG is a CPA firm, and we work with closely held businesses and family groups to provide tax, accounting, and other advisory services. So we're really happy to be here and talk to you today about some really favorable changes that recently came out on the employee retention credits. And so I want to start it off with Allison. Allison, to get us started, could you explain a little bit more about what the employee retention credit is and why it's relevant to our audience today?
Sure. So the employee retention credit is a fully refundable tax credit that employers can take that's based on the wages that they paid to their employees in 2020 and in 2021. The credit actually came into play a year ago in March of 2020, right when all this madness started with the passage of the CARES Act. But the original legislation forbade PPP borrowers to also take the employee retention credit. So at that point, business owners had to choose whether they were going to take the PPP loan or whether they would claim this employee retention tax credit. And most businesses decided to go with PPP. Understandable, it's grant-free money. It makes perfect sense that they took that. And so they left that employee retention tax credit on the table. When President Trump signed the COVID relief bill this past December, the law changed so that now PPP borrowers were suddenly eligible to also claim this employee retention credit. And as we'll discuss throughout the presentation, you'll see why businesses in the hospitality industry are very likely to fall into the parameters of the credit. But I want to be clear that any type of business can qualify, even nonprofit organizations. We did receive a few questions ahead of the presentation, so I wanted to make clear that this is a refundable credit. You would calculate the amount of the credit on your payroll tax reports, and if the credit exceeds your tax liability, the difference would be refunded to you in cash. It's not a loan or a grant like PPP. You do not have to pay this money back. And as to why this credit is so powerful, I want to talk in dollar amounts. So an employer may be able to claim as much as $5,000 per employee for the 2020 year, and as much as $28,000 per employee in 2021. And as we know, this cash would be a welcomed relief after the rough year that hospitality businesses, all businesses, have had.
So we can see that this is really a significant amount of money. And so Allison, could you go ahead and go over the specifics of the credit?
Sure. So to be clear, there are separate rules for calculating the credit for 2021 versus 2020. And in your reference materials, you should see something called a comparison chart. And this is a comparison of the rules for each of the years because they're different. So if you have that available, go ahead and open it. Otherwise, you'll get it after the presentation. But let's start with 2020. So the credit applies to wages paid after March 12, 2020 and before January 1st, 2021. That's the time period of wages for this 2020 credit. The maximum amount of the qualified wages that can be taken into account with respect to each employee for all calendar quarters of 2020 is $10,000, and the credit is equal to 50% of all qualifying wages. So this means that the maximum credit per employee is $5,000 for the 2020 year. For 2021, employers can claim the credit equal to 70% of the wages they paid to employees. And again, the wages are capped at $10,000 per employee, but this is per quarter. So this is a big change from the 2020 rules, which capped the wages at $10,000 for the entire year. The 2021 rules cap the wages at $10,000 per employee per quarter. So this means that the maximum credit in 2021 is $7,000 per employee per quarter. So that's $10,000 cap times 70%, $7,000 times 4 quarters. So the maximum amount of credit that you can take is $28,000. So I should make something clear that originally the rules only allowed us to take the credit in 2021 through the end of June. But because President Biden signed that American Rescue Plan Act a few weeks ago, now you can claim this credit for the entire year of 2021.
So Annette, could you tell us a little bit more about how a business can qualify for these credits?
Sure, Melanie. So the first way is if you've had a full or partial suspension of business due to a government order that restricts commerce, travel, or group meetings due to COVID-19. Now you can take the credit for the entire period in which the government order is in place. The second way that you can qualify is if you've had a significant reduction in gross receipts. And as we know, COVID has had a huge effect on all of our businesses. Under this method, it's calculated on a quarter by quarter basis. And so there are different thresholds for 2020 and 2021. For 2020, you must have at least a 50% reduction in gross receipts compared to the same calendar quarter in 2019. And you would qualify for that first quarter in which you've had the 50% reduction, and you would continue to qualify for each additional quarter after that until your reduction in gross receipts goes below the 20%. And so for 2021, it's actually much easier to qualify for the credit. You'll still compare your gross receipts to the same calendar quarter in 2019, but you only need to have a 20% reduction in gross receipts. And you will keep qualifying for every quarter in 2021 in which you have had the 20%, at least a 20% reduction in gross receipts.
So Annette, does a business need to prove that their reduction in gross receipts was caused by COVID?
No, Melanie, it really doesn't matter what caused the reduction in gross receipts. As long as you meet the thresholds, you're going to qualify.
Okay. Well, Allison, could you tell us what qualifies as a partial suspension of business or a full suspension?
Sure. If a government order restricts the operations of your business has either a partial suspension or a full suspension. So for example, here in Texas, until recently, our state and local governments placed restrictions on restaurants and bars, which did not allow them to operate at full capacity. And as such, restaurants and bars in Texas will likely qualify for this credit because they had a partial suspension of their business operations. Furthermore, an essential or non-essential business may qualify for the credit if they had a supplier that was forced to suspend operations. So for example, an auto repair shop was allowed to remain open as an essential business, but the supplier that it uses for its raw materials was forced to shut down by government orders. So in this case, the auto repair shop would qualify because it was indirectly affected by government orders.
And so, Allison, can you tell us which government orders would qualify under these provisions?
Sure. Government orders are orders, proclamations, or decrees from a federal, state, or city government that limit commerce, travel, or group meetings due to COVID-19. Examples include an order from the city's mayor stating that all non-essential businesses must close, a state's emergency shelter-in-place proclamation, an imposition of a city curfew, or other order mandating a workplace closure for cleaning and disinfection. For example, if a city curfew restricted the hours of operation for your business had a partial suspension and it qualifies for the credit. If a portion of your business was restricted, such as in-person dining, but other portions were not restricted, like carryout, your business also experienced a partial suspension caused by government orders. The IRS has some very specific examples of these rules in a notice that they issued, and we included it with your reference materials. And I don't want anyone to panic. I know that it's an IRS notice and those can be a little bit overwhelming, but I promise that the language is pretty easy to understand. It is long, it's 100 pages, but we added bookmarks to it to help you navigate to the section that you're interested in looking at. I should make it clear that this IRS notice provides guidance on how to calculate the credit only for 2020. It's not specific to the 2021 rules, although they are similar, but the IRS hasn't released guidance for 2021 yet, or at least official guidance. So we included that so you can look at these examples because they do get into some very detailed specifics that I think you'll find really helpful.
Well, so Allison, I know some of the governors have lifted suspensions and allowed businesses to operate without restrictions. So in these cases, which quarters are going to qualify? And then how would you calculate the gross receipts test on the quarters?
Sure. So Annette touched on the gross receipts by quarter, and the rules get really complicated at that point. We really want to focus today's presentation on making sure that everyone feels empowered to look at these rules and determine if their business qualifies. Once you qualify, then you can focus on calculating it, which I think is a secondary matter at this point. I really want our listeners to focus on figuring out whether they qualify for it or not. So I think that's a little outside the scope of what I'd like to get to today.
Okay, well, that makes sense. So I know you mentioned that the credit's based on wages. So Annette, could you tell us a little more about how do we know what wages qualify?
Sure. Well, it really depends on if you're considered a large employer or not. And the thresholds are different, again, for 2020 and 2021. In 2020, a large employer is one that averaged more than 100 full-time employees in 2019, not in 2020. And for 2021, a larger employer is one that averaged more than 500 full-time employees in 2019. And this is going to really make a huge difference in the amount of credit that you're going to be eligible to take for your employee wages. So if you're considered a large employer, you can only take the credit on wages that were paid to employees that were not performing services due to government orders or a decline in business. So I know a lot of you were under government orders to shut down in restaurant dining, maybe you could only do takeout or delivery. So if you shut down your dining room and you still decided that you were going to pay your wait staff, you would still be able to take the credit on the wages of those employees that you continue to pay while they were not working. But now, if you're not a large employer, you can take the credit on all wages paid, whether your employees are working or not working. So huge benefit, much bigger benefit if you're not considered a large employer. However, keep in mind that you're still going to be subject to the maximum limitations that Allison mentioned earlier. That would be for 2020, 10,000 per employee per year. And in 2021, that goes up to 10,000 per employee per quarter.
Well, so in trying to figure out whether or not someone's a large employer, how do they go about calculating the employee's time and figuring out if they're full-time or not?
Well, again, these calculations can get somewhat complicated, but in simple terms, a full-time employee is one who in 2019, again, we're going back and we're basing these thresholds on 2019, but it's a full-time employee who averaged at least 30 hours of service per week, or who averaged at least 130 hours of service in a month.
Okay, so when someone goes to calculate the credit, what do they include in the qualified wages for the calculation?
Okay, so that's going to be your gross wages paid to the employee on the Form 941, plus the cost to maintain a group health plan, but only to the extent that the health insurance benefits would not be included in your employee's gross income. So this is going to include the amount that you pay as an employer for your employee's health insurance benefits, and also the amount that the employee contributes towards those benefits, but only to the extent that the employee pays those with pre-tax dollars.
Okay, so I know we have a lot of business owners in the audience today, and probably quite a few of them pay themselves a salary. And so can they claim the credit on their wages too?
That's funny that you asked that, because I did have a client ask me that just a couple of days ago. No, you would not be able to take the credit on your own wages or on the wages of any family members that you might employ.
So are there any other restrictions that everyone needs to be aware of?
Yes, there are a few. So if you take the credit for qualified sick and family leave wages, which was also another credit that was implemented under the CARES Act, or if you happen to take the work opportunity tax credit, and I know a lot of restaurants do. So if you take either one of those, you can't take the employee retention credit on the same wages.
Okay, that makes sense. Well, so Allison, I know we started out this presentation explaining that PPP borrowers are now eligible for this credit, which they most times hadn't been before. So I know a lot of businesses have already gotten their PPP forgiveness. And how does that impact the credit for them?
That's a great question, because that's really been one of the hot issues that I've been looking at the last few weeks. If your business received a PPP loan, as we talked about, you now qualify for the credit. But the general rule, very similar to what Annette just talked about, is that you can't double dip on the wages that you use for both programs. So in other words, the payroll that a business used to qualify for PPP forgiveness, those that they included in their forgivable expenses, cannot be used in calculating the employee retention credit.
Well, this I know is a problem for a lot of people, because a lot of PPP borrowers have already applied for their forgiveness before we got these new rules that made them eligible. And so what happens in those cases?
Well, as you might remember, the covered period that you had for your PPP loan was originally 8 weeks, and then they extended it to 24 weeks. So most businesses had more than enough payroll to cover the full covered period and to qualify for full forgiveness. And so many of our clients that qualified for full PPP forgiveness did so using wages alone. They didn't need to include all those other non-payroll expenses, rent and utilities. They had plenty of payroll over those 24 weeks that exceeded their PPP loan. And so when they filed for loan forgiveness, to keep things as simple as possible, they just put payroll on their PPP forgiveness application and submitted it to the bank, because as many of you know, applying for your PPP forgiveness has been complicated, and you had to submit a lot of documentation to the bank. And so in an effort to keep things simple, we had a lot of clients that just submitted payroll because it exceeded the PPP loan amount. So why would they include the other things that they had? We were really hoping that the IRS, when these rules changed, we were hoping the IRS would allow us to almost recalculate the PPP forgivable amount to include those non-payroll expenses. But the IRS has taken a too bad, so sad position on this issue, unfortunately. So the IRS will allow a business to calculate the credit on the wages that exceeded the PPP loan amount. So remember how I said that most businesses, their 24 weeks of payroll greatly exceeded their loan amount. So that difference between the two, you could use those wages to qualify for the employee retention credit. However, if you did not include any non-payroll expenses on your loan forgiveness application, it's unfortunately too late to do so.
Okay, well, thank you. So I know we have a lot of owners who might have more than one business. So if they have related businesses, how does that affect the calculations?
You would need to look at the aggregation rules. So basically, businesses under common control are treated as a single employer for purposes of applying for the employee retention credit, for claiming the credit, I should say. And if you're a part of the aggregated group, you would use the same rules that we just went over, but you would have to apply them to the group as a whole. This can work in your favor or against you. For example, if one member of the group suffered a partial suspension, then all members of the group are considered to suffer a partial suspension, even if one member is located in a jurisdiction that was not subject to any government order. But when you apply gross receipts, you have to sum the gross receipts for the aggregated group and then use that to determine whether you had a 50% reduction in 2020 or a 20% reduction in 2021. So you could see how that could preclude you from taking this credit.
So for the aggregated group rules too, do we need to look at the number of full-time employees for the entire group?
Yes, so that's exactly right. So let's say that we're calculating our credit for the 2020 tax year, and you had employer A and employer B, and they are an aggregated group. This is not an optional thing. If you are an aggregated group, you're an aggregated group. So let's say we have two employers, A and B, they're a group. And employee A and B each had 75 employees. So together as a group, they have 150 employees. Well, remember what Annette talked about, those large employer rules. If you had more than 100 employees in 2020, you're considered a large employer. And if that's the case, then there are restrictions as to which wages you can claim this credit on. It's only for the wages that you pay to employees for not performing services. So on a standalone basis, each of these employees would be considered a small employer, but once they're aggregated, they're a large employer, and that changes the rules that you have to follow to qualify for this credit.
And so then obviously the rules are different for 2020 and 2021. But Annette, can you tell us, once you have those rules figured out, how do we go about taking the credit?
Well, you're going to report the credit on your Form 941, your quarterly federal payroll tax return. This is going to offset income, Social Security, and Medicare taxes that are withheld from your employee's wages, as well as the share that the employer pays of Social Security and Medicare tax. And to the extent that the credit exceeds these amounts that would be due on your 941, you can actually receive a refund.
And so people, do they need to wait until they file their quarterly 941s to get the money back, or are there other ways to claim the credit?
So there are a couple of ways that you can get your money back in your pocket more quickly. In anticipation of the credit, you can actually reduce your quarterly required payroll tax deposits. And if you think that the credit's going to exceed your payroll tax deposits, you can apply for an advanced refund by filing Form 7200. And just remember, the whole point behind the credit is to get money back in your pocket more quickly to fund your current and your future payrolls, to keep your employees working and keep your business running.
Well, and so we're talking about 2020. And so obviously all of the business owners on this call have already filed all their 2020 payroll tax reports. And so what do they need to do to claim the credit for 2020?
Melanie, you can actually amend your 2020 payroll tax returns to take the credit and request refunds. This is done on the Form 941X.
Okay. And so since this credit is related to payroll taxes and the payroll tax return, it doesn't affect their federal tax return. Is that correct?
Well, unfortunately, it does affect your federal income tax return a little bit too. You have to reduce your deduction for wages for the amount of the credit that you take. So you may end up paying a little bit of additional income tax, but the net benefit should be very beneficial to you still.
Okay, so probably we have a lot of businesses on the call today that use a PEO to do their payroll or their payroll tax filings. And so are those businesses still eligible to claim the employee retention credit?
That's a great question, Melanie. The IRS actually addressed a specific question. The answer is yes. Employers that use a third-party payer or a PEO can still qualify for the credit. The credit would be claimed on an aggregate Form 941. However, if you want to submit your own Form 7200 to claim that advance credit that Annette talked about, you can do that.
So I know this is really a lot of complicated information for everyone to digest. And so Allison, who's the best person to help a business get started on claiming these credits?
My first suggestion would be to call your payroll provider and ask them how they are assisting their clients with these calculations. In our experience, most payroll providers will assist you with filing the amended payroll reports or with the Form 7200, but they will not help with the analysis. Most payroll providers are not set up to help their clients analyze gross receipts, see which government orders may apply to you, or calculate the excess payroll from the PPP Forgiveness application. I do know some payroll providers that are doing this, so I think that's where I would start, is by calling them and see what they can help you with.
Well, and it sounds like there are a lot of things that your payroll provider could help with, and then things they can't help with. So probably it's a good idea for people to contact their CPA, who will be more familiar with gross receipts tests and maybe some of these other areas. Although I know most CPAs are in the middle of their busiest time of the year, and these rules are changing constantly. So everyone is trying to learn it as quickly as they can. But I know today our goal was really to provide enough information so that our audience can go and look at the tests and kind of pre-qualify themselves to see if they would be able to qualify for the credit.
Yes, and as we wrap things up, I'd really like to add that based on my experience so far, this credit has been far more sizable than any of us had initially anticipated. One of our restaurant clients that owns 2 locations just applied for a credit that was close to $400,000. And then another client that I worked on earlier this week, a small nonprofit, they have about 35 permanent employees, and they hire a good number of seasonal workers over the summer. We were able to calculate a credit of just over $200,000. So this is a lot of money. You don't want to leave anything on the table, especially if your business is still suffering as a result of COVID. So I'd like to close in saying that it would be in your best interest just to empower yourself with knowledge, so at least you can have a more meaningful discussion with your advisors, or maybe even prepare the calculation yourself. So I'm just going to finish by summarizing the steps that you would need to go through to kind of perform the initial assessment. First, you're going to want to determine if you qualify for the employee retention credit, either as a standalone entity or as an aggregated business like Allison talked about. This is going to have a big impact on how you go about doing the calculations. Second, you're going to want to determine how you can qualify for the credit. Is it going to be based on the government order, or is it going to be based on a reduction in gross receipts? So next, after that, you're going to want to calculate the number of employees. And remember how I talked about earlier that the number of employees is going to help you determine if you're a large employer or not under these rules. And don't forget about the aggregation rules either. But once you calculate the number of employees, then you'll determine, can I only take it on wages for employees that are not working? Or if I'm not a large employer, do I get to take it on all wages, regardless of if my employees are working or not? And then finally, you're going to go through the calculation. You're going to calculate your qualified wages, determine the maximum that you would be eligible to take for each credit for each employee during the period 2020 or 2021. And remember that you need to back out any wages that you use to qualify for PPP loan forgiveness. So I know that there are a lot of nuances to these rules, but you can at least do a ballpark assessment if you take it just one step at a time and go through that analysis. But certainly, talk to your CPAs or other financial advisors, and hopefully they can provide you some guidance on this.
Well, thank you, Annette and Allison. Liz, I know we were wanting to wrap up quickly, and did you want to take time for a couple of questions, or people can send those to us in the chat and we'll address those in a follow-up?
Yeah, we will. We just had the one question. Bailey Spalding asked, is the 20% decrease in gross receipts standard for 2021 compared to 2020 or 2019?
Okay, so the 20% decrease in gross receipts is standard throughout 2021. It's the same threshold for every single quarter. And you compare each quarter in 2021 to the same calendar quarter in 2019. So as long as you've had a 20% reduction in gross receipts, you should qualify for that quarter. And I saw somebody had also posted a question asking what we mean by gross receipts, and does that equate to revenue? Yes, that is your revenue, and that would be your revenue as you calculate it for federal income tax purposes. So if you use the accrual method for federal income tax purposes, you would use the same method in doing this calculation. If you use the cash method, you would use the same method for that.
Fantastic, thank you. Yeah, I would urge all participants to click on the link that you see in the chat bar and use password LADOMS. There are handouts on that site. There's everything that I think will give you more detail, more of a primer, so that you can go ahead and pursue this, whether with your payroll company or your accountant. A lot of this was way over my head, but I know for restaurant owners and other business owners, I think this was very useful. So I want to thank you guys, ATKG team, for joining us. We appreciate your time, and Leslie, we appreciate you helping bring this to the table for everybody. And we'll have a recording available on the LDEI website and a follow-up email as well. So thanks, everyone.
Thank you.
Thank you.
Bye-bye.